Most traders think the market whispers its intentions. But in my experience, the market doesn't whisper, it shouts. The real trouble is that most folks never trained themselves to listen. And that's what I want to talk to you about today, how to recognize big shifts fast. Before we dive in, I should say this ties naturally into something I mentioned in the previous video on how I cut my losses in half. Because understanding shifts is useless if you don't already know how to step aside when you're wrong. Now, you've heard me say many times that prices are never random. They may look like a tangle of numbers to the untrained eye, but there's always intention behind a major move. The public calls it chaos. Traders call it opportunity. The market is forever telling you what it wants to do next. The real question is, are you watching closely enough to catch the change of tide when it happens? When a market has been rising steadily, everyone becomes comfortable. Comfort is the most dangerous emotion in speculation. A trader who gets comfortable stops looking. He starts assuming. And when he assumes the trend will continue just because it has been continuing, he sets himself up for a fall. I always found that comfort was a signal to sharpen my senses. Do you ever catch yourself relaxing in the middle of a trend as if the market owes you another day of profit? One thing I learned early is that big shifts never start big, they start small, tiny cracks in the wall. A rally that slows, a decline that hesitates, a sudden surge in volume on a price that refuses to move higher. Those are hints, and the market never gives hints for no reason. If you train your eyes to see those hints early, you'll be in position before the crowd even knows something changed. And trust me, being early, not reckless early, but aware early, is often the difference between catching a wave and getting drowned under one. Sometimes the best clue comes from how the market reacts to news rather than the news itself. A strong market shrugs off bad news, a weak market wilts under even the smallest push. When I watched tape in my day, I wasn't reading numbers. I was reading character. You can do the same today on any chart. Does the price behave with strength? Does it hold levels that matter? Does it do what a healthy trend should do? If it doesn't, that's your first bell ringing. Ever notice how the market's reaction often tells you far more than the headline? And I'll tell you something else. You can't recognize a shift unless you're calm. Excitement blinds you. Fear blinds you. Traders think they need adrenaline, but what they really need is clarity. Clarity comes from discipline. Discipline in your rules, discipline in your risk, and discipline in your observation. This is exactly why the lesson from that earlier video, where we talked about cutting losses, fits here. If you're quick to cut your losses, your mind stays clean. And a clean mind sees turns before a cluttered one ever could. Look closely at the places where price hesitates. Markets speak at those edges. When a price refuses to push past a level it used to jump over easily, that's a message. When a decline slows even though every trader on the street is screaming, sell, that's also a message. These messages form patterns. Accumulation, distribution, tightening ranges, failed breakouts. Study them enough and they become as familiar as the handwriting of an old friend. And let me ask you, do you take the time to study how a price behaves when it's tired? I used to say that the big money was never in the buying or the selling, it was in the waiting. That waiting becomes much easier when you know what you're waiting for. A major shift doesn't come from random bumps, it comes from pressure building. Smart money positions itself quietly. They don't announce their presence. They nibble, they test, they feel the market. That's why you must learn to watch volume, watch how price reacts after an impulsive move, and watch how the crowd behaves at old highs and old lows. The crowd reveals more about the coming shift than the chart sometimes does. Most traders don't fail because they can't spot moves. They fail because they're too busy chasing to notice the change. They chase the last move, the last breakout, the last rush of emotion. Meanwhile, the shift has already begun behind them. When you stop chasing and start observing, you put yourself in a position to recognize a major turn before it becomes obvious. Does that sound like something you've struggled with before? Getting there only after the move is already halfway through. Remember, The market rewards the trader who notices what others ignore. It punishes the trader who ignores what others eventually notice. That's why your mindset matters just as much as your method. A clear, patient, self-controlled trader spots reversals quickly because he isn't biased by hope or fear. Hope blinds a trader to warning signs. Fear blinds him to opportunities. A neutral trader sees them both. Every meaningful shift in my career came after a series of small hints. A stock stops making new highs. The character of the advance changes. The dips aren't bought as quickly. The rallies shrink. The tape looks heavier even though the price isn't falling yet. That heaviness is often the first indication of a top. A similar lightness appears before a bottom. Does the market feel heavy or light to you lately? And don't overlook the simple principle that ties today's topic back to the earlier lesson on cutting losses. When you cut losses quickly, you remove hesitation. A trader who hesitates misses the early signals of a shift because he's still emotionally tied to a position he should have left. Clean exits lead to cleaner perception. Clean perception leads to faster recognition. When you learn to read the early signs, hesitation at key levels, abnormal volume, failed pushes, changes in volatility, you stop needing predictions. You start following the market instead of arguing with it. And that's when your trading becomes less about guessing and more about listening. And once you start listening correctly, you'll notice that the market always warns you before a major turn if you're willing to pay attention. There's a quiet moment before every storm in the market. A moment where the tape acts differently, where the pattern shifts just enough for the trained trader to feel it. And I've always believed that the trader who learns to catch that moment stands in front of opportunity long before the rest of the world sees what's coming. When traders first come into the market, they imagine big shifts arrive with fireworks. Huge candles, violent gaps, headlines screaming across every corner of the financial world. But the truth is far quieter and far more subtle. The market doesn't hand out invitations to its biggest moves. Instead, it gives you small, almost polite hints that something beneath the surface is changing. And that's why early shifts show up as subtle changes in price behavior, not dramatic moves. The dramatic part comes after the shift has already begun, once the crowd finally catches on. But by then, the real advantage is gone. To understand this properly, you have to look at the market the way a seasoned operator does. Not as a series of random candles, but as a living thing with habits, tendencies, rhythms. Every trend has a personality. A healthy uptrend moves with confidence. Pullbacks are shallow, rallies are smooth, and dips get bought quickly. A healthy downtrend shows the opposite. Rallies fail fast. Selling pressure returns in waves, and the path of least resistance is clearly lower. When this personality changes, even slightly, that's when the earliest signs of a major shift appear. They won't shout. They won't shine. They whisper. And the question is, are you training yourself to hear that whisper? One of the most important lessons a trader learns is that the first sign of trouble, or opportunity, usually looks insignificant. A trend that has been marching cleanly in one direction suddenly hesitates at a place where it shouldn't. A rally that normally bursts through resistance now pauses, flickers, and pulls back with a touch more heaviness. A decline that should roll downhill with ease suddenly holds steady and refuses to break the next logical level. These small anomalies are the fingerprints of a shift long before the shift becomes visible. Think about how professional money operates. They don't flip a switch and reverse an entire market in a single moment. They build or unwind positions over time, carefully, patiently, and without drawing attention. Because of that, the earliest signs they leave behind are incredibly subtle. A little less strength here, a little more resistance there. A slowing of momentum. A hesitation that wasn't there last week. The big traders aren't trying to create noise, they're trying to avoid it. Which means the big turn starts quietly. Most retail traders ignore these signs because they want certainty. They want the market to announce, the trend has ended, or a new move has begun. But the market never does that. The market changes character before it changes direction. That's why the real skill isn't predicting the turn, it's recognizing character shifts as soon as they begin. Ask yourself, do you notice when the tone of the chart changes, even slightly, or do you only react when the move becomes obvious? Subtle price changes matter because the market leaves clues in behavior, not in explanations. A trend losing steam is like a strong runner beginning to slow, not because he's stopped running, but because he's running out of breath. If you only notice when he collapses, you're far too late. But if you notice the slight change in pace, you're the one who sees what's coming before the crowd does. Look at the way price interacts with support and resistance. In a strong uptrend, resistance isn't really resistance. It's just a temporary ledge before the next climb. When price suddenly hesitates at a level it should have sliced through, that's the first sign of a problem. In a strong downtrend, support isn't support. It's simply a short resting point before the next leg lower. But once price starts holding those levels instead of breaking them, something deeper is shifting. These behaviors reveal far more than any indicator because they show actual intention in the market. Another subtle sign is how the market reacts to volatility. Big shifts often begin when volatility compresses, not expands. The market gets quiet before it gets loud. Ranges tighten, candles shrink. Trading feels slow, almost dull. Most traders get bored and stop paying attention at exactly the moment they should be watching more carefully. Because compression is the market storing energy. And when that energy releases, the direction of the release tells you everything. But the early shift, the real beginning, happened during the quiet part. A trader who wants to catch major moves early must train themselves to value these minor signals. The goal is not to jump into a trade the moment something small changes. The goal is to become aware, mentally prepared, and ready to act when confirmation arrives. Awareness is the edge. By the time everyone else sees the big candle, the news headline, the breakout or breakdown, you're already positioned or already cautious. You're not reacting. You're anticipating, not through prediction, but through observation. The subtle price changes are not predictions, they're warnings and invitations. A shift starts with the market acting just a little differently than it used to. And that difference, once you learn to recognize it, becomes one of the most powerful tools a trader can possess. When traders talk about news, they usually talk as if the news itself moves the market. Good earnings, bad earnings, strong jobs report, weak economic data. People assume the headline is what creates the buying or selling. But seasoned traders know something very different. The reaction to the news matters far more than the news itself. The market's behavior after the headline tells you the real story. And that's why recognizing how price responds in those moments becomes one of the earliest ways to spot a major shift before it turns into a full-blown move. Here's the truth most beginners never learn until the market teaches it to them, the hard way a strong market absorbs bad news better than a weak market absorbs good news. That simple idea reveals almost everything about trend strength, institutional intention, and the underlying pressure building beneath the surface. Think about what that really means. If a stock or index gets hit with a negative headline, something that should push it down, but it barely budges, that's a clue. Not a loud one, not dramatic, but a quiet signal that buying interest is waiting underneath. Someone is absorbing the selling. Someone is more interested in accumulating than panicking. That someone is rarely the general public. It's usually the steady hand of institutional money. On the other side of the equation, when a market can't even hold a rally on good news, that's a sign of exhaustion. The fuel that once powered the trend has been spent. Traders who wanted to buy have already bought. Now the slightest excuse, profit-taking, hesitation, uncertainty, overrides even positive catalysts. That is not the behavior of a strong market. That is the beginning of a shift in character. And you can spot it long before the chart shows any obvious reversal patterns if you're paying attention to how price reacts instead of how headlines sound. You have to remember that news is public information. It reaches everyone at roughly the same time. If something is truly shocking or unexpected, sure, you'll see a burst of volatility. But most of the time, the market has already priced in the expectation of the news before it arrives. The smart money often positions ahead of the headline because they understand probabilities, cycles, earnings patterns, and macro trends. So when the actual announcement hits, the reaction tells you whether the market was prepared or surprised, strong or fragile, greedy or cautious. Imagine a stock in a solid uptrend. It has been climbing for weeks, maybe months. The company releases slightly disappointing news. Not catastrophic, just below expectations. A weak market would sell off aggressively. But a strong one might dip, shake out some traders, and then quickly recover. Maybe it even closes higher that same day. When you see that, ask yourself, what does that say about the underlying demand? If bad news can't push it down, what will? This kind of reaction is often an early indicator that the trend has more strength left than the crowd realizes. Now flip the scenario. A stock that's been drifting, struggling to push higher, suddenly reports great news, better numbers, strong guidance, good forecasts. The public gets excited. Social media lights up, everyone praises the stock, but instead of rallying hard, the price spikes for a moment and then falls back down. Maybe it ends the day flat. Maybe it even turns red. What does that tell you? It says the market expected more. It says the smart money used the excitement as an opportunity to sell into demand. That kind of reaction usually appears near tops, right before the broader trend begins to roll over. Reactions matter because they reveal intent, and intent is something the raw headline never shows. Charts are the visual representation of how every participant interprets the news. And because large players can't hide their footprints forever, their buying or selling pressure becomes easier to detect in those key moments when the market should behave one way but chooses another. You can apply this principle across all time frames. Day traders use it around intraday catalysts. Swing traders watch it during earnings weeks. Position traders look for it during major economic reports. The logic remains the same. A strong trend shrugs off negative catalysts, while a weak trend wastes even the best opportunities. This is why you must shift your mindset from reacting to news to reading reactions. A trader who waits for the news to tell them what to do is always late. A trader who lets the price reaction speak for itself is far ahead of the crowd. And here's a question worth asking yourself when news drops. Do you focus on the headline or on how the market behaves in the seconds, minutes, and hours afterward? When the market barely responds to something big, that's a clue. When it overreacts to something small, that's another clue. When it spikes on good news but can't hold the gains, that's pressure. When it dips on bad news but refuses to break down, that's support. And support and pressure always show themselves in reaction, not headlines. This principle works especially well during turning points because news often becomes the catalyst that exposes the true direction. When the conditions are already shifting beneath the surface, the reaction to news becomes magnified. Traders who understand this can spot a major trend change days or weeks before a clear reversal pattern forms. They don't need predictions. They just need awareness. Recognizing big shifts fast comes down to observing how the market absorbs information. Not what the information is, but how the crowd and the deeper pockets respond to it. And when you practice this long enough, you start to realize that the strongest moves in the market aren't born from the headlines themselves, but from the emotional and structural reaction that follows them. Big shifts don't come out of nowhere. They look sudden only to the traders who weren't paying attention. To the trained eye, they start with tiny cracks, small, almost invisible changes in how price behaves. A rally that once looked confident begins to slow. A decline that used to push smoothly lower suddenly hesitates. These are the earliest signals, the subtle tremors before the earthquake. Most traders overlook them because they expect a major shift to announce itself loudly, but the market rarely works that way. It whispers before it shouts. And if you learn to recognize those whispers, you start catching turns long before the crowd wakes up. The reason big shifts start small is because real money moves gradually. Institutions don't flip entire positions in a single day. They scale in, scale out, test levels, disguise intention. They don't want the public jumping in ahead of them. So the first signs of accumulation at a bottom or distribution at a top always appear as tiny irregularities. Nothing dramatic, just slight changes in how price responds to pressure. When a decline begins losing momentum, it's like a heavy object rolling downhill that suddenly feels a little resistance. You wouldn't call it a reversal yet, but something isn't behaving the way it did before, and that change in behavior is your clue. Slowing rallies are just as telling. When a trend is strong, rallies push through resistance cleanly. Pullbacks are controlled, dips are bought, and momentum feels alive. But when a rally grows tired, each push becomes a little weaker. The price might still make new highs, but barely. The candles get smaller. The urgency fades. Traders who know what they're looking at can feel the tiredness, even before the chart spells it out. A rally doesn't need to collapse to reveal trouble. It just needs to lose the snap it once had. That's usually the first sign that buyers aren't as eager and that demand is starting to dry up. Weakening declines tell the same story but in reverse. Imagine a downtrend that has been carving lower lows with ease. Suddenly, the next sell off doesn't travel as far. Instead of slicing through support levels like a hot knife, the price struggles. Sellers still push, but buyers step in earlier than before. The bounces become a little stronger. The downside pressure fades just a bit. Most traders write this off as randomness or noise, but experienced operators know better. Those slight signs of strength in a previously weak market can indicate that buyers, the real buyers, are starting to accumulate. The market speaks in behavior. That's why traders who only chase patterns without paying attention to character often arrive too late. They wait for obvious signals: a breakout, a breakdown, a headline, a giant candle. By the time those appear, the early shift has already been happening quietly for days or weeks. The subtlety is the edge. The big shift doesn't start at the obvious moment. It ends there. The beginning is much smaller, almost ignorable, which is why most people miss it. You can see this clearly if you watch how volume interacts with price during those early hints. A slowing rally paired with rising volume is a warning. It means buyers are working harder just to maintain the same progress. That's not sustainable. A weakening decline with falling volume can reveal exhaustion. It says sellers are losing interest. Little by little, those patterns form the foundation of the larger shift that will eventually become obvious to everyone else. But the trader who learns to see these tiny clues gets the luxury of time. Time to prepare, to plan, to adjust. Think about the way the crowd behaves. Most traders only get interested after the move has already shown itself. They don't care when the rally is slowing. They care when the chart breaks down dramatically. They don't care when the decline weakens. They care when the breakout is clear and broad. But if you're always waiting for the crowd's confirmation, you'll always be late. The market gives you the chance to see the turn early. But only if you're watching for the right things. One of the simplest signs that a big shift is approaching is when the market stops doing what it should be doing. A strong trend should behave in a certain way. When it doesn't, even slightly, that's your cue to pay attention. Trends change their character before they change their direction. That character change starts with tiny cracks in the structure: slowing rallies, weakening declines, subtle failures at key levels, small divergences between price and momentum. These cracks widen over time until they become the reversal everyone sees. But the opportunity lies in noticing them early, not after they explode. Most traders look for certainty, but early shifts aren't about certainty. They're about awareness. Your job isn't to predict the turn at the exact moment it happens. Your job is simply to recognize the earliest signs that the current trend is losing momentum or gaining hidden strength. Once you learn to spot these early cracks, the market stops surprising you. It starts communicating with you in advance, long before the public reaction confirms what you already sensed. Emotional neutrality is one of the most overlooked skills in trading, yet it's the one thing that separates the trader who spots early shifts from the one who's always a step behind. Most people think trading is about charts, indicators, strategies, or predictions. But long before any of that matters, your emotional state shapes how you interpret every move the market makes. When fear or hope or excitement gets involved, your perception bends. You don't see the chart for what it is. You see it through the lens of what you want it to be. And that's why emotional neutrality becomes such a powerful edge. It lets you notice subtle changes that emotionally charged traders overlook. Think about how many times traders ignore obvious clues on a chart simply because they're invested in the outcome. A trader holding a long position wants the price to keep going up, so when the rally slows or starts showing weakness, he doesn't see the early signs. He sees normal fluctuation. He sees just a pullback. His bias filters out the shift. Another trader stuck in a losing short position will convince himself the market is overbought, even when buyers are clearly in control. These emotional filters aren't harmless. They blind you to the very signals that warn you a trend is changing. A neutral trader, on the other hand, isn't attached to any particular outcome. He doesn't care if the market goes up, down, or sideways. He only cares that he sees the truth of what's happening. And because of that, he notices tiny changes immediately. A neutral trader sees when the dips aren't being bought as quickly as before. He sees when sellers start absorbing demand at a level that used to be easy to break. He sees when momentum fades before a top forms or when volume dries up before a bottom takes shape. Those little observations are only possible when your mind isn't clouded by what you want to happen. Emotional neutrality doesn't mean being cold or detached from the world. It means being free from internal pressure. When you're neutral, you don't feel the urge to force a trade. You don't try to prove you're right. You don't chase the market because you're afraid of missing out. Your decisions slow down internally even though the market moves fast around you. This clarity allows you to hear the market's whispers. When fear or excitement grips other traders, their senses narrow. They miss the soft signals. You, on the other hand, notice when the character of the trend shifts even slightly. One of the clearest advantages of emotional neutrality is how it changes your relationship with uncertainty. Most traders can't handle uncertainty. They want confirmation, reassurance, and certainty before they take action. But by the time the market gives them certainty, the big move has already started. Early shifts are subtle, fragile, easy to dismiss. Only a trader who's not emotionally entangled can trust what he sees without demanding that the chart prove it. This is why emotional neutrality makes subtle changes stand out. Suppose a stock has been trending up for weeks. Every pullback has been shallow. Suddenly a pullback goes a little deeper. Not crash level deep, just deeper than it should. An emotionally attached trader shrugs it off. A neutral trader asks, why did that happen? What changed? Another tiny example, a breakout that should have run doesn't run. It hesitates, it stalls. The candle closes weak. A neutral trader sees that immediately. Someone emotionally invested sees it as just the first attempt. Emotional neutrality keeps your perception clean. Clean perception means early recognition. Early recognition means you position yourself ahead of the crowd, not behind it. And the crowd is almost always reacting emotionally, which is why they're late far more often than they're early. If you think about the best traders, Livermore, Wyckoff, Davers, all the great operators, you'll notice something in their writing. They talk constantly about patience, discipline, detachment. They weren't emotionless people, but they didn't let their emotions steer the ship. They used logic, observation, and experience. The market punished them every time they allowed emotions to slip into the equation, so they learned the hard way that neutrality wasn't optional. It was survival. Neutrality is a mindset you cultivate by practicing restraint. You learn not to react instantly to price spikes. You learn not to jump in simply because others are excited. You learn to wait for behavior, not promises. You learn to observe without trying to predict. Predictions involve ego. Observation involves neutrality. The more you practice this, the faster you start noticing the quiet signs that a shift is beginning long before the explosive move confirms it. The subtle signals, slowing rallies, weakening declines, strange pauses, failed pushes, are incredibly easy to ignore when you're emotional. But when your mind is calm, steady, unbiased, those signals become unmistakable. It's like taking a foggy windshield and wiping it clear. The road doesn't change. Your ability to see it does. Most traders try to control their emotions, But emotional neutrality isn't about suppressing them. It's about removing the conditions that trigger emotional reactions in the first place. Proper risk sizing, clear rules, cutting losses quickly, not overtrading. These are the foundations of neutrality. When you don't feel threatened by a single trade, your mind stays open. And when your mind is open, the small clues that lead to big shifts become impossible to miss. Emotional neutrality doesn't turn you into a robot. It turns you into a listener. A trader who can hear the market's tone changing even when the words remain the same.